Hello everyone and welcome back to XM.com. It's Thursday, August 8th. Global markets have been in consolidation phase so far this week, and that's normal after a volatile week. Investors are probably waiting for more data releases to get more clues about whether the US economy is heading for a recession. Perhaps some analysts think that the Fed is already too late to cut interest rates, and perhaps the US economy is already in a downtrend, but that remains to be seen. In the meantime, US CPI and retail sales data will be out next week to provide us with more information about whether a more aggressive 50 basis point rate cut is likely in September. UK CPI, inflation, employment and GDP figures will be also out next week, so pound dollar might be a key major pair to watch. In other news, the Reserve Bank of New Zealand is scheduled to announce its policy decision on Wednesday, so Kiwi dollar might be also under the spotlight. And finally, WTI oil futures could also attract attention as the globe is still waiting for the Iranian attack in Israel. So having a look first at pound dollar, we can see that pound dollar compared to other major FX pairs continue to trade to the downside. It hit a new low around 1.2670 earlier this week, and since then it has been stable around this level. That territory is crucial because this is where the 50% Fibonacci retracement of this up leg, the 200-day moving average, as well as the support trend line coming from October 2022 are all placed here. So that could be a key pivot territory, but looking at the technical indicators, they are all trending to the downside. They have yet to show any significant improvement, so the bias is still skewed to the downside. Perhaps a break above the this resistance trend line coming from May 2021 could help the price to gain extra positive momentum towards the 1.2814 and 1.2867 zone, where the lower band of this bullish channel, the 20-day moving average and the 23.6% Fibonacci number are all positioned within the same region. Now, alternatively, if the price were to break below the 200-day moving average, support could initially come near the 1.2583 mark. This overlaps with the 61.8% Fibonacci level and the falling trend line coming from July 2023. Failure to pivot here could take us down to 1.2512, and then lower than that, a bigger obstacle could be the 1.2443 region and this key support trend line coming from October 2023. Looking now at Kiwi dollar, while the Reserve Bank of New Zealand is expected to cut interest rates next week, the odds for a rate cut have declined after the release of a better than expected employment report, but the base scenario is still for a rate cut, so it will be interesting to see whether the central bank will use a hawkish tone to help Kiwi dollar to extend this rebound. From a technical perspective, the technical risk is positive. We can see that the pair has created a double bottom pattern, which is a bullish trend signal. The technical indicators down here are also sloping upwards, but some caution is required as the RSI has yet to climb above 50 and the stochastic oscillator is near its 80 overbought level, so downside risks haven't entirely faded out. Perhaps if the 0.6025 level gives way, this is where the 50% Fibonacci retracement of this up leg over here is located. Then we may continue higher to test the descending trend line coming from June's high near 0.6065. The 200-day moving average is also nearby at 0.6082, so a clear break above this region might be important for a significant rally up to 0.6147 and 0.6173. This is a trend line zone, and the 38.2% Fibonacci level is also located here. So that could be the next obstacle. Now, if the price, if selling forces return, pushing the price below the 0.5965 zone, where the 20-day moving average and the support trend line from October 2022 is placed, then the decline could stretch towards the 0.59 level. That's the 61.8% Fibonacci number. Lower than that, I expect a tough battle near the 0.5850 base, a break of which could increase the odds for a bearish trend reversal, driving the price sharply down to 0.5772. That's taken from the low of October 2023. Not far below that, the 0.5730 could also attract attention, since this is where the 78.6% Fibonacci level is placed. And finally, looking at WTI oil futures, oil prices had a nice rebound yesterday, rising as high as 75.82, but we see that some weakness has emerged today. And if you look at the technical indicators, they have yet to show significant improvement. So the RSI has yet to make higher highs above 50. The stochastic oscillator is also in a sideways move despite its latest rebound, and the MACD is still negative despite its recent progress. So downside risks remain. Nevertheless, that rebound near the support trend line coming from May 2023 has increased the case for a new bullish cycle. So I expect the continuation up to the 61.8% Fibonacci retracement of this supply currently seen around 77.73 and around the simple moving average. As if that proves easy to overcome, then the next barrier could emerge somewhere between 81 and 82. That region overlaps with the 50% Fibonacci level and this key descending trend line coming from September 2023. So a clear break above this zone could confirm additional gains, likely up to the 38.2% Fibonacci of 84.33. Now, if looking to the downside, the support trend line, which held the price to be a bit higher, will be closely watched, along with the 78.6% Fibonacci of 73.04. We saw the price pivoting twice around this region, so that will be closely watched. If it fails to hold, however, we may see a decline towards the 69.25 region. This is where this almost flat trend line from June 2023 is placed, so that could attract attention ahead of the 65.75 by 67 region, where another trend line is placed. And this is also where the price bounced up a couple of times last year. So that's all from me today. Thank you for watching. Our video content will pause for 2 weeks for a summer break. So wish you have a great time. Our next technical analysis video will be out in 2 weeks. Thank you for now and see you next time.